Hello, everyone. This is Edwin Epperson, your host of The Sophisticated Investor. The Sophisticated Investor is an incredible community which is focused on education, training, and collaboration to help each of our members, and that includes you, to build, protect, and preserve your family's generational wealth. Now, I believe that we truly have a unique and one-of-a-kind educational community. For one, I believe that there are 4 primary markets, not just one. I believe that those 4 primary markets include your personal finance and mindset market. I believe the second market is your hard, tangible asset market. I believe that the third market is your stock and paper market. And I believe the fourth market is your business investing market. Now, those 4 markets are imperative to be able to understand and then call yourself a sophisticated investor. Today, we have an incredible guest who is going to educate us on their preferred market of investing as well as the assets that they like to invest in. Please join me as we welcome today's guest. And today we have with us Pete Pratti. Pete, welcome to the show, The Sophisticated Investor. Thanks for coming on and talking to us about the hard tangible asset market.
Sure. Yeah. Thanks, Edwin, for having me on. I'm excited to talk about this stuff.
Well, this is going to be a very interesting and very engaging show. I can promise all the listeners that. So real quick, Pete, a lot of people I've interviewed and had on the show, they, got storied backgrounds. They've been in business for decades and decades, and you're in a very unique position. Your background is a little bit shorter, if we can't say that. So let's start off with this, just an upfront question. How old are you? And then let's dive into where you're at now. And then we'll sort of backpedal and sort of catch the listening audience into how you got to where you're at now, especially considering your age.
Mm-hmm. Yeah. So I just turned 22 years old 2 weeks ago.
That's awesome.
So I was actually just got out of college about 6 months back in December. So I graduated 6 months early. And funny enough, I guess we'll dive into this as we circle back around for how I got started. But I actually have a nursing degree, which is really funny. So I guess I'll kind of tell the story of how I got started and where all this came from.
Well, before you do that, so we could sort of frame, because when we say the hard tangible asset market, so let's define first, so what are you investing in now? And then let's backtrack, because I think that it's going to really set the stage of, wow, Pete's really on a roll. He's going someplace in life. So tell us exactly what the asset is that you're investing in within the hard tangible market. And then let's dive back and sort of take the listening audience to where you are at now.
Sure. Yeah. So right now where we're at is we have just under 100 rental multifamily units in Knoxville, Tennessee. So these are properties with anywhere from 4 or more units that we'll look at purchasing. And these properties, we feel have a good upside because they cash flow and they have appreciation on the exit. So that's what we invest in, and to fuel that investment, we do flipping houses as well. So, but we're mainly focused on this hard, tangible, multifamily asset, ones that are already built.
Okay, excellent. All right, so perfect. So you've got you said just under or just over 100 doors? Just under 100 doors. I believe in the form that you had filled out, it's right around 5 million AUM. You've got about $5 million in assets under management.
That's right. Yeah.
So, and you're 22 years old. So for the listening audience, this isn't something that you need to wait till you're 30, 40, 50 before you get into multifamily. You can do it now. So let's go back, because you just graduated college 6 months ago. So it wasn't like you had this long period of time after college where you're like, yo, what am I going to do? I want to invest in multifamily real estate. Let me get some experience and all this. So take us back how this started.
Yeah. So, I guess going back until the end of high school, really, which it seems like a long time ago, but not really. I was looking at careers that I wanted to do. And, I'd thought about business a little bit, here and there, but I have a lot of family members in healthcare, and I kind of settled on being a nurse anesthetist, which is an anesthesia type nurse specialty. And they make a good salary. I think it would be a good job, not a ton of hours really. And the schooling, you don't have to go get your doctorate degree, right? But as I got into college, and I played college baseball as well, and I did really well in school. And I, about 2 years into college, I kind of caught wind of the whole real estate and business world, which was, ended up being a good thing to where I am now. But it was a true struggle to complete college when I had that bug that I caught after the first year or two.
Right.
Yeah, it was really tough. I mean, I still kept my grades up pretty well. But just the fact that I was in completely two different industries, from college to business. And the reason why I didn't switch my major or anything was because I would have had to keep going for another year. I'd still be in college right now. And that would have hindered me long term. So I wound up making the decision to just go ahead and go through 2 summer semesters so I can get done a little earlier. So I wound up getting done 6 months early last December 2018. And all the while was building up the business with 2 other partners to where we are now. So that's kind of the short version of the long story there of how we got started in investing in these hard tangible assets and where I am today.
Well, that is fantastic. Now, I want to dive into your partners. So, and I think so everybody that I've talked to, everybody that has been a successful, and as you've stated, a great, somebody that's memorable, somebody that has made a true impact, not only in their local communities there in Knoxville, Tennessee, but in the region, Southeast region, the United States, and the United States, even in the world. There has never been a person that has done it by themselves. They've always had a team, and teamwork, having that support network is so key and critical. Walk us through. So what did that look like? So what was the point? Like, would you say you got introduced to real estate investing? What was the point? Was there a definitive moment? You went to a meeting, a seminar, something that said, wow, this is really incredible. And then how did you meet your current partners?
Yeah. So that's a lot to delve into right there. So I guess I'll start by saying that my partner right now, one of my partners right now, I had known since I was 16 years old. And we lived around the block from each other. We went to different schools. So it was kind of funny how that worked out, but we wound up becoming pretty good friends. And he actually got started in real estate a little bit before I did. And he was doing some flipping and things like that. And he was doing pretty well. And of course, we had friends that were involved with us as well, but they would kind of just look from afar, as I would say, not be interested in what was going on. And at the time I thought, well, that's really cool. I mean, I don't have to, just close my mind off to every other form of making money or living my life besides the track that I was going on. So I started getting kind of interested in that. And I have to give him a lot of credit because, he didn't have to help me or sit around and answer questions when I asked them, but he did. And that was really helpful to me. So that was how I met my first partner.
Okay.
How I met my second partner is actually his brother. So,
okay.
So that's Harper, and his brother is Hunter. And Hunter's the old wise man. He's 25. And so that's how the partners came about and how that happened. And I would say a defining moment was he recommended the book Rich Dad Poor Dad to me, which I'm sure a lot of the audience has read. It's a very good book, and I probably should circle back around and read it again. But that was a book that struck me because the concept of cash flow, the concept of passive income, and not working for someone else, but working for yourself to make your own kind of luck, as some might say, was big for me, because some of the main points in that book was how the guy's father was a teacher and he had all these degrees and he had spent all this money getting these degrees, but he didn't have this huge pay that it would be worth it. He was always working for his money, even though he had all this education. So that made me think, I have a family that, between my grandfather, my parents, my grandparents, aunts, uncles, they all work actively for their income. And that was the only way for me when I was growing up to say, okay, this is how I'm going to make a living. I'm just going to get a job in this profession. Where that book opened my mind up to the fact that I don't need to just get a job in some profession. I can actually be an entrepreneur, which is something I had never thought of before. Wasn't discouraged from it, but that was all I ever knew, was to get a job somewhere. So that was a defining moment for me when I read those pages. And then from then on, I was pretty tone deaf to everything outside of just doing that.
Right. So I will have to say that my very first book that I ever read in 2008 was also Rich Dad, Poor Dad. And for me, that was a revolutionary shift in the way that I viewed investing and the way that I viewed income. And he's written a lot of other books. There are many other books that Robert Kiyosaki has written, author of Rich Dad, Poor Dad. And if you ever get a chance, I don't know how many of the other books that you've ever read, but he's got some really, really incredible ones. You could go on Amazon and look them all up. But so fantastic. So you met these, well, you said you grew up with Harper in high school. Like you knew him since you were 16 years old, right? And then Hunter was his older brother, and you got introduced to him after you got involved in this business. And you started that a year and a half into college, so into your sophomore year?
Right. Yep, okay. Right into my sophomore year.
All right. And so now you guys, so he was, Harper was actively, and I'm assuming Hunter was too, they were doing this together as brothers. So they were, was that true?
So Harper was doing it actively. Hunter was going to go into underwriting for a bank. He actually joined us about a year ago. So he kind of came on after I had already been exposed to it.
I see. Okay. Mm-hmm. All right. Well, there you go. And so when you and Hunter first started collaborating and say, wow, this is really eye-opening, he was simply doing fix and flips, or that's what we would call in the industry. Basically, you're repositioning smaller single-family homes, you're buying them at a discount, turn around, you add value to them by improving the property, then turn around and selling them to an end buyer, which is typically a homeowner, right? So that's what you all were doing. Where did the transition happen from single family fix and flip investing? And I have to assume, I don't know, but I have to assume that you all had some wholesales worked in there as well to generate cash.
Yeah, it was actually mostly wholesales with a few flips mixed in. So I kind of use the term interchangeably, which is confusing to some people because I know what I'm talking about, but I got to explain it a little more. But yeah, we do a lot of wholesale. We did a lot of wholesales, and the transition came in where it was kind of that same concept in Rich Dad, Poor Dad, where you can keep making that active income, but until you make that passive and until you make your money work for you, then you'll never break the chains of the rat race, as he calls it. So that's where the transition came in. We knew we wanted to hold assets at some point, but of course you can't really hold assets on a really grand scale if you don't have some kind of money, right? So, I mean, you can do creative financing and things like that with no money down, and owner financing real estate and things like this, and raising capital as we do now. But we had to get some starter capital. I mean, we can't just have, a $20,000 salary and start putting $1 million deals together. It just doesn't really work that way. And we had to get some credibility in the space as well as to start generating some income. So that's where the transition happened, is once we started doing well with that, we started saying, okay, now we're ready to take some assets down long term. And so we at first thought, single families, I guess, would be a good asset to take down. And now I actually really follow Rich Dad, Poor Dad to a T, because he was a lot of single family. There was a lot of single family that was brought up there. We do apartment buildings. So, basically commercial real estate is 4 units or more. So that's basically all we'll look at to hold long-term now is 4 to 6 units or more. Preferably, double or triple that per apartment complex. So that's where that transition happened. And we still have that wholesaling flipping business now. It's still a great source of generating that short-term income, but it's taxed the highest. It's active, so you have to keep working for it. and you don't have that generational wealth. So that's where that came into play, the big apartment complexes.
Okay. Okay. Excellent, Pete. Well, I think that was very early on. And I have to say, thank God that you guys that was revealed to you all early on, that that's really where you want to transition to. And I 100% agree. And I believe that, keeping your wholesale, your fix and flip business alive for that cash infusion is what I would call it, is really critical, because it allows you to continue to grow and scale. And I'm assuming you all are using leverage when you all are taking down these assets, right?
Absolutely.
Okay. So for those who may not be familiar with what leverage is, when Pete and I are talking about that, it's he is using borrowed capital along with their own capital to take that and be able to control an asset or own an asset that is more than what he could purchase with himself in his cash.
Right.
So walk us through, walk me through, because so people may be listening to this and like, oh, wow, that sounds, I want to go out and I want to start investing in multifamily and apartments, and maybe they have some experience, maybe they don't have any experience. But I think in everyone's mind, and this is funny because you probably know this better than most people, but the market is, when I say the market, the hard tangible market is flush with cash right now. People are leaving the stock market in droves, and they want their capital tied to a secured hard tangible asset, and they want some security and safety compared to what they've experienced in the stock market, even though it's been on an upwards climb for the past 5 years or so. It's unstable. I mean, I remember just this year, in the past 6 months, we've had multiple times every month where the Dow drops 600 points, the S&P is down 10%, whatever the case may be. It's just this obviously roller coaster. That's what the stock market is known for. So walk us through, when you decided to start scaling and taking down bigger assets. Obviously you, Harper, and Hunter started looking at your bank accounts and the capital. You don't want to use all of your capital into one deal. That would be detrimental. So you obviously said, okay, we need to leverage. Now, obviously, to leverage, take down a apartment complex, you need a little bit more than just, a few $1,000s to put down. You've got to put down quite a bit. So what did that conversation start to look like when you started to talk to people who had capital?
Yeah, great question, because this is probably the biggest holdup with people, is they say, I don't have the money to do that, or I don't know anybody with money that does that. And, I would encourage it. The number changes every day, but I would encourage people to go to the circulation calculators and see how much money there is circulating in the world. And there's trillions of dollars in cash and equity floating around in the world. So if you can't pick up a couple 100,000 from your network of people, or expand your network, I would say that that's very possible. So how we started talking to these investors was, it started in the wholesaling. Hey, we're wholesaling these properties, we're flipping these properties in real estate, but the income is good, as you guys might see from afar, but we really want to go towards passive income and generational wealth through apartment buildings and through buying cash flowing assets like that. And so it was just kind of familiarizing people with our strategy and what it was going to be long term, just kind of prepping them verbally for what was going to kind of come up on the horizon, getting them comfortable. We had a few lenders for short term projects too, that we would give them an interest only type payment for short term projects, like $100,000 over 6 months, and they would make $833 a month on the 10% interest on, or something like that. So they were already kind of a little comfortable lending to us. And so that when we got into these apartments, they were even more comfortable and trusted us even more to be an equity investor in that sort of deal. So it all starts, it doesn't start when you get the property under contract. It does start before that. And you need to build twice as many relationships as you think you might need to buy an apartment complex, because people's situations change all the time. So that's how those conversations took place, and that's what we kind of did. And of course, you'll always run into things, but just talking to everybody about what you're doing. You're at a bar. People like to go out on the weekends and stuff, right? Instead of using that time to waste, me and Harper and Hunter like to use that time to talk to people about what we're doing, and I think we've all done a great job of that.
Excellent. Excellent. I have to ask you then, so what is your percentage of capital raised from a bar?
So I will sidestep that question and say that a large percentage of our capital, or a good portion of our capital, has come from meeting people in the steam room at gyms. Funny enough, and how unique that sounds, you go to the gym, there's people that are, more bound to, especially it's a more nice upscale gym, something like that. People that are taking care of themselves, that are, especially if they're older, they have some money built up. They're, kind of a classy type person, or accredited investor profile. And so we have gotten an investor from that type of scenario. And of course, meeting people out and things like that too. But that's the most unique thing I can say, is that you're sitting there sweating in a steam room after your workout, and somebody asks you, wait, you guys do apartment investing? I would like to get into that. So you can meet somebody anywhere, really anywhere.
That's fantastic, man. I want to speak real quickly to something you said earlier. You said if you can't, you should be able to raise a few $100,000 from your existing network, or if that's not in your existing network, and you mentioned it briefly, but it's really powerful, expand your network. And I think that a lot of people are so stuck in, I didn't come from money. I don't have a higher degree. I don't have a college education. My family never had money. I grew up in a trailer park. I grew up in the backwoods of Tennessee, right? My network at a maximum may have $10 to their name, right? So that may be the mentality of somebody that is wanting to get invested in real estate, and they realize that they don't have the capital. They need to raise the capital. And if somebody says, well, you should be able to put the money together from your existing network, they say, oh, well, that's not going to happen for me. But then you mentioned expand your network. And then you just mentioned a place where you have met an investor, which is a nice gym. And so I wanted to, for everybody who's listening, I wanted you all to listen to what this young man is saying about expanding your network. Pete, you had mentioned an accredited profile, which is what I use in our industry as well, where we raise capital for our private mortgage fund. And we have to identify, hey, who is our ideal client? Who is our avatar? The term is synonymous, but it all relates to who is that profile that we need to go after, who has capital that wants to invest. Where are some of the other places that you all have plugged into? And I'll drop a few places as well for the listening audience that says, you know what, I have an idea, it's a business plan, or I want to invest in real estate, or I want to do this type of investment, no matter what it is, but where do I find the capital? Where are some other places that you, Hunter, and Harper have actually gone to raise capital?
Yeah, so I would say first that we have met people in various places, but we're never going to these places specifically looking to raise capital. So I like to think whenever you have an ulterior motive for something, whenever you're trying to do things and it's clear that you're trying to sell somebody or do something like that, they're going to see your motives, right? So we just go to any, given place and just kind of be ourselves and talk about what we're doing. So, that could be the gym, that could be the steam room or the sauna, that could be restaurants, bars, that could be LinkedIn. That could be any given place that you are, a doctor's office, right? I mean, you can be in a number of different places, law offices, right? So there's places that obviously people are that have more money than a significant amount of money that they may likely be looking to invest. So it's just kind of everywhere. You just really never know who you're going to be talking to or where they're going to be. Mm-hmm. But I think going in with the mindset of just having a conversation with someone, just kind of talking about, what they do, what you do. And you never really know. And you might spark up a good conversation, especially now you have phones on your hip every second. There's no excuse to not get somebody's number and kind of follow up with them down the road.
There you go. Follow-up is absolutely key and critical. And I 100% agree with you. If you go, for anybody that's listening and they're like, okay, I've got a business plan, I've got an investment strategy, I want to start looking at this investment. So where do I go to find these investors? Okay, I'm going to go to the local gym and I'm going to start talking to everyone. Hey, I'm looking for investors. I've got this investment. Would you be interested in investing? You're absolutely right. That turns people off like that. Like they're shut down. Hey, get away from me. Like I wouldn't touch you with a 10-foot pole. However, going with hey, this is what we're doing. And even more importantly, what I've done is here in Tampa, in the Tampa Bay, Florida area, I wanted to get involved in organizations that are either attractive to what I like to do, going to the gym. I love scuba diving, so getting involved with scuba meetups, something that actually has nothing to do with investing, something alternative that I can connect with those people on whatever that meetup is or whatever that activity is. And it doesn't come across like, okay, I'm here to find investors. Like, where are the investors? And so I think that's really powerful. I want to go ahead and name a few other places for any listeners that want to put themselves in an environment to where they are networking, they are rubbing shoulders and elbows with people who have a level of sophistication, maybe where they're trying to attain, or they are accredited investors. Rotary clubs, Kiwanis clubs, your local chambers of commerce, your local economic development committees. The Chamber of Commerce and local economic development committees are tremendous. If you are wanting to get invested in real estate, or you are wanting to start a business, regardless whether it's real estate or not, those two social networking places are tremendous. You cannot overstate or understate the importance of those events. So there's some locations. So go to the gym, find an activity that you personally enjoy, and then go join that activity on Meetup or Eventbrite, wherever, and then getting plugged into your local social events, local clubs that are giving back in some way. And I can promise you, like Pete said, you will come across people that will be attracted to you, your personality, what you're trying to do, and then want to jump on board.
Yeah, I will add one too. I actually, sometimes you kind of have to make a little bit of a sacrifice. And this may sound like a no-brainer, or it might not sound so obvious, but there's a local country club here in town. And that one is some, different ones are different prestige levels. This happens to be a really nice one. And right now I'm in a position to where I can afford the place, but it's not necessarily a practical decision if I'm just going there to kind of pamper myself, right? But it's something I am in a position to afford right now. I actually just joined. I'll be accepted there within the week or so. And I'll be probably one of the youngest members there, but I think that will be an outstanding destination to meet people. But for the short term, it's a little bit of a sacrifice because it is very expensive. And so I have to kind of, make sure I use that to its full potential. So it might, you might have to spend some money. You might have to do some marketing to find investors, especially if you want to do this on a large scale. If you want to do 100 units a year like we do, you got to have a lot of investors for that. So that's something that I'm doing right now. And I know Harper and Hunter have spent money on occasions to get investors. And that's something that you may have to do, but it's a long-term vision, right?
So I want to dive into some of the way that you all analyze and look at investment opportunities. And we are coming up right around 30 minutes right now. So we'll talk for a few more minutes and then we'll start to wrap it up. But I wanted to dive in real briefly into your all's overarching strategy. Right now, you're invested in Knoxville, Tennessee. Where is the future for Pete, Harper, and Hunter in let's say the next couple of years?
Yeah, so I think, right now we really want to grow this business, both of them. We have the flipping and wholesaling business. We have our apartment complexes. And something that I haven't even mentioned yet is we have a whole management company in-house that manages all of our rentals. And that Hunter primarily takes on and does a phenomenal job. And I would just like to say that is part of being successful in these deals. So kind of backtracking from that, how we analyze deals is a lot of it comes from that management company. If you don't have a competent management company, it'll kind of mess your numbers up. So when we get a deal in, we initially look at it and we say, okay, there's a price per door in the area that people pay for different class assets. And what do I mean by that? $50,000 per unit or $60,000 per unit is something you can quickly take a look at and say, okay, maybe this is a reasonable deal. If something is going for $50,000 a door and it comes across your desk at $80,000 a door, it might not be worth the time to sit down and take a look at that if it's in the same class of assets that you're comparing it to. So we do have a spreadsheet. We have a short, quick spreadsheet that we have. We can have the rents and just put our expenses in there that we know, and we can underwrite a deal in probably 10 to 15 minutes. We have a long, drawn out spreadsheet as well from Michael Blanc. And that one, if I believe he has a podcast as well, Michael Blanc. It's just Michael, and his last name is BLANK. And he has a nice spreadsheet for syndications and raising capital to buy apartments. He has a good spreadsheet for that. And so we'll put it into that spreadsheet actually. And basically the expenses you need when you're underwriting a deal, you need the rents for the income, all the income it has. And then you need to just deduct all your expenses. So you have your mortgage if you're using a mortgage, which everyone should if they're buying apartment buildings. You need the management expense, which we bill to our management company. You need taxes and insurance, and you need to factor in maintenance, repairs, things like that. Those are basically kind of the encompassing factors. And of course, you'll have your contract stuff, trash, lawn, things like this that, pretty much stay pretty stagnant across, for any given year or two, right? Expenses aren't going to drastically change between a year or two. There's going to be a little bit of inflation, but you can get a good idea of what a trash company's charging, what maintenance costs on apartments, things like that. And that's how we'll underwrite deals really quickly. And we can get sellers back their answer really quickly, or a broker. We can get them an offer and say, within 15 minutes, this is where I have to be to buy this apartment complex, which is really important in this market to be able to get back with feedback quickly. So that's how we underwrite. That's probably a whole 2-hour podcast in itself.
Oh yeah. Well, and that's really important too, because a lot of people don't know how do you even look at an apartment complex and decide whether this is going to be a good buy? And having spreadsheets or calculators, or as you said, and same in my industry, we need to underwrite a project. We need to know about the numbers. We need to know about the details, and then basically underwrite that asset, and then be able to spit out in a pretty quick format, hey, this is where we need to be at, especially if you're on the buying side. Man, Pete, I'll tell you what, I think it's fantastic. I want to ask you real quick so you're looking at apartment complexes. Does your management company, does the section that Hunter operates, have you all considered, or has he considered managing short-term rentals such as Airbnb, VRBOs?
No, actually not. I think that's a whole nother sector in itself that people are doing really well in right now, actually. And I don't think that we just want to manage our own properties for now and possibly expand in the future to other people's. But so no, we haven't looked at that. Okay. And I think that'd be a whole nother to go into. We kind of want to stay a little bit too. If anybody follows Grant Cardone, he says, you know what, I'm a coward. I don't want to lose my money. We want to do the same thing, kind of. We want to stick to apartments for now and just do that one thing and grow from there, right? If we master that, then great.
There you go. Well, I definitely would love to have you back on to talk a little bit more about your underwriting process. And then we will make sure we put in the show notes Mr. Michael Blanc, and we'll make sure that because if somebody is interested in having or connecting with somebody that's got a good Excel spreadsheet or some type of calculator underwriter, then that would be fantastic. So tell the listening audience how they can reach out to you. Tell us the platforms, and then of course how they can find you on that platform.
Yeah, so we've got a couple of different platforms for company-wise as well as personal. And my name is Peter Pratti. You can find me on Instagram, Peter. My last name's Pratti on Instagram. You can find Harper and Hunter through my Instagram as well, I'm sure. Our company Instagram is arrow_door. So just ARROW_DOOR on Instagram. We're fairly active on there. And we even have a number that when someone is on podcasts or something like that people can call in, and we'd be happy to answer questions from people or anything that somebody has to ask. I mean, we're pretty open with that kind of thing. And I'll give that number.
Yes,
it's area code 865-730-2621. And you feel free to call that number at any time. and it's a dedicated line just for podcasts and stuff like this. So, those are pretty much the main areas you can reach us. And I hope everybody got value out of this, and we'll be happy to educate people, on a personal basis as well.
Fantastic. Well, thank you so much for being on the show. We appreciate it. I appreciate it. We'd love to possibly have you back. We could talk more about the underwriting process that your Hunter and Harper go through to look at assets and decide whether you're going to take them down. So I appreciate it. Thank you for being on the show.
Yeah, thank you. I appreciate it, Edwin. I'd be happy to come back.
Excellent. We'll talk to you soon.
Awesome.
And that wraps up our show for The Sophisticated Investor. Thank you so much for joining me and joining our guest today as we dove into the specific assets and the market that they invest in. Please join us again when we dive into more investing techniques and strategies in different assets within different markets so that we can help you, the listener, and our community member build, protect, and preserve your family's generational wealth. This is Edwin Epperson, your host of The Sophisticated Investor. God bless and have a great rest of your week. There we go. I appreciate it, my man.
Yeah, absolutely. And, it's something podcasts are pretty fun, it's a little, I would love to have one in person at some point. That'd be cool if I'm ever in Tampa, but
absolutely.
It's kind of funny that you don't know when each other are going to talk sometimes, But yeah, that was good. Hopefully people got good info. It's hard to not delve into so many details, right? Because there's so many. Underwriting is really a long
it's the critical crux of being able to know what type of asset or which asset you all are going to buy. And so let me ask you a key metric. Do you all look at the NOI or do you look at your cash on cash return?
So we'll look at both. What we care about more is the it depends on what we're looking for. So cash on cash return is important for us because if we're syndicating out a deal, we can't give investors a 4% return, right? So we've got to hit at least a 7 to 10% cash on cash return. Me personally, if I was just buying a deal, I wouldn't care as much about cash on cash return. I would care if it's a good asset and it has good upside, but we have to choose one that has good upside and has a good cash on cash return. But the main thing we're focused on really is, NOI is important, but not as important to us, I don't think. One thing we're focused on is, can we get that up to a higher level in a reasonable amount of time? So if we have a deal that's grossly under rented and the seller wants a little much to justify the cap rate it's currently on, I really don't care about that as much, as long as we can reasonably get that deal up to speed and not speculate, So the last place we bought 35 units, the rents every month were like $20,000 and change a month. And he had a house on the property that could rent for like $1,500 that he was living in. They were all under rented too. So we paid quite a premium for the rents he was currently bringing in, but we have that property at $28,000 gross a month, which is an increase of $8,000 a month, which is an enormous increase when you're talking about commercial property per month at that scale. So we didn't really care what cap rate we were paying at that point. If we're paying a 6 cap, I don't really care. It's a 9 cap now. So so it doesn't really matter. Market is around 6.5, 7 cap, I guess, right now. But we easily raised it. Not easily, but we raised it pretty quick.
So when you all are looking at your asset, which assets to take down, you all are really focused on value add assets. How can we strategically add value, increase the rents in as short amount of time as possible? Right.
Yeah. I mean, we definitely want to, I don't want to buy things right now necessarily, unless the right deal came along that was just kind of stagnant, just mailbox money. I'll take mailbox money when I'm 40. or something, right? We have so much time and energy right now. No families, nothing. So we want things that we can really add value to. That's where the big upside comes, is when you can get something that's cash flowing pretty decent. You get it cash flowing really hot. And then 5-7 years down the road, then you let inflation take its course. And that's where this stuff becomes pretty deadly. So
let me ask you this one last question, then we'll go ahead and wrap it up. The investors that you all are bringing into your deals, I'm assuming you all are using syndications, correct?
Yeah. So we're syndicating, but we're also put our own money in.
Okay. So let's say you're going to take down an asset at cost, for round numbers sake, just round numbers. Let's say it cost $100,000. How much are you all using leverage as a percentage? And then how much are you all using your investors as equity?
It depends on the property. Some of them, if it's a smaller deal, we'll take it down in cash and just refi. So we'll take it down with other people's cash in 100% leverage and then refinance. But mainly, if we're going to just take down a deal with permanent debt, we'll do like 25% down, something like that. So we'll do like a 75% LTV or an 80% LTV. Depends on what the property can support at the time. But when we get into institutional loans like Fannie and Freddie and stuff like that, on refis, you're pretty much at 75% LTV. Yeah. Maybe able to find some 80%, but usually like 75 to 70% LTV. So that's the kind of type of leverage we use. We've never done any construction finance before. We'll just do the permanent debt, and we'll take a big reserve account up front for repairs, and we'll just kind of let that ride.
There you go. Okay. Excellent. Yeah. All right, my man. Well, I will let you go. Like I said, we're going to be sending this off. You've got about I've got 6 in the hopper right now being edited. It's going to be a few months before we get this one to the air, but I'll be in touch. I'll make sure I connect with you and Hunter and Harper on the different social media platforms, and then I'll reach out and let you know when we're about to launch it.
Yeah, that's terrific. I'll look out for you on Instagram or Facebook or whatever. If you give me a follow, well, I'll probably give you a follow right after the call. But I do appreciate. Yeah, it was a really good time, and I'm always happy to talk about this stuff. It's really good stuff. So.
Excellent. Well, I appreciate you being on the show. Appreciate it, Pete, and we'll be in touch soon.
Absolutely. Take care, Edwin.
All right. Bye. Yeah.